Let's talk about how potential US tariffs on Canadian goods could shake things up for BC's economy and mortgage rates. Whether the tariffs are 25% or a lower rate, the effects will be felt eventually. But how will this impact mortgage rates? Here's what we're looking at. If the US imposes tariffs on Canadian goods, it'll hit our economy hard, worsening the recession already looming over BC. The Bank of Canada would likely respond by continuing to lower rates, making variable rate mortgages more appealing. But there's a twist. Canada might counter with its own tariffs on American goods, which could drive up prices here at home. That's inflationary, and inflation could push the Bank of Canada to raise rates instead. Confusing, right? Now, what about fixed mortgage rates? Here's where it gets even trickier. US tariffs could weaken our economy, pulling rates down. But if counter-tariffs lead to inflation or US tax cuts push their deficits even higher, bond yields could rise, and higher bond yields in the US often spill over into Canada, driving fixed rates up. For BC homeowners, the big question is, should you go with a fixed or variable rate right now? A 3-year fixed at 4.29% offers stability, but could mean missing out on years of potentially lower variable rates around 3.25%. A variable rate keeps things flexible, but rising inflation or bond yields could push rates higher. Here's the reality. For the first time in years, it's incredibly hard to predict where mortgage rates are headed. With global trade wars and economic uncertainty, BC's housing market and the rates tied to it are caught in the crossfire. The strangest part, the future of Canadian mortgage rates might depend on one man's decision: Donald J. Trump. That's where we are. The only question is, how will BC's economy adapt to these global uncertainties?